In this video, we are going to talk about investing and money management. So before starting this video, please like this video and subscribe to our channel for the future updates. What is investment management? Investment management refers to the handling of financial assets and other investments, not only buying and selling them. Management includes devising a short or long-term strategy for acquiring and disposing of portfolio holdings. It can also include banking, budgeting, and tax services and duties as well. The term most often refers to managing the holdings within an investment portfolio and the trading of them to achieve a specific investment objective. Investment management is also known as money management, portfolio management, or wealth management. Investment management refers to the handling of financial assets and other investments by professionals for clients. Clients of investment managers can be either individual or institutional investors. Investment management includes devising strategies and executing trades within a financial portfolio. Investment management firms handling over $25 million in assets must register with the Securities and Exchange Commission and accept fiduciary responsibility toward clients. Save first, spend later. As a rule of thumb, it helps to first save some part of your monthly income and then start spending your money on regular essentials like groceries, rent, electricity, loan repayments, insurance premiums, etc. So, plan what you want to do with your money in the short as well as long term. In order to achieve your long-term financial goals like your dream house, your child's education, retirement, and much more, you must start investing in financial products. Remember to always set realistic goals with set timelines. This will help you stay motivated and ensure that your money is well spent. The plan offers 4 portfolio strategies, and you can choose any of these as per your goals and risk appetite. Understanding investment management. Professional investment management aims to meet particular investment goals for the benefit of clients whose money they have the responsibility of overseeing. These clients may be individual investors or institutional investors such as pension funds, retirement plans, governments, educational institutions, and insurance companies. Investment management services include asset allocation, financial statement analysis, stock selection, monitoring of existing investments, and portfolio strategy and implementation. Investment management may also include financial planning and advising services, not only overseeing a client's portfolio but coordinating it with other assets and life goals. Professional managers deal with a variety of different securities and financial assets, including bonds, equities, commodities, and real estate. The manager may also manage real assets such as precious metals, commodities, and artwork. Managers can help align investment to match retirement and estate planning as well as asset distribution. In corporate finance, investment management includes ensuring a company's tangible and intangible assets are maintained, accounted for, and well utilized. According to an annual study by research and advisory firm Willis Towers Watson, the investment management industry is growing. Based on the combined holdings of the 500 biggest investment managers, the global industry had approximately $131 trillion in assets under management at the start of 2022, an increase of more than 10% from the previous year. Running an investment management firm. Running an investment management business involves many responsibilities. The firm must hire professional managers to deal, market, settle, and prepare reports for clients. Other duties include conducting internal audits and researching individual assets or asset classes and industrial sectors. Aside from hiring marketers and training managers who direct the flow of investments, those who head investment management firms must ensure they move within legislative and regulatory constraints, examine internal systems and controls, account for cash flow, and properly track record transactions and fund valuations. In general, investment managers who have at least $25 million in assets under management or who provide advice to investment companies offering mutual funds are required to be registered investment advisors. It also means they accept the fiduciary duty to their clients. As a fiduciary, these advisors promise to act in their clients' best interests or face criminal liability. Firms or advisors managing less than $25 million in assets typically register only in their states of operation. Investment managers are usually compensated via a management fee, usually a percentage of the value of the portfolio held for a client. Management fees range from 0.35% to 2% annually. Advantages and disadvantages of investment management. Though the investment management industry may provide lucrative returns, there are also key problems that come with running such a firm. The revenues of investment management firms are directly linked to the market's behavior. This direct connection means that the company's profits depend on market valuations. A major decline in asset prices can cause a decline in the firm's revenue, especially if the price reduction is great compared to the ongoing and steady company costs of operation. Also, clients may be impatient during hard times and bear markets, and even above, average fund performance may not be able to sustain a client's portfolio. Professional analysis, full-time diligence, ability to time or outperform market, ability to protect portfolio in down times, sizable fees, profits fluctuate with market, challenges from passively managed vehicles, robo-advisors. Since the mid-2000s, the industry has also faced challenges from two other sources. The increase of robo-advisors, digital platforms that provide automated, algorithm-driven investment strategies and asset allocation. The availability of exchange-traded funds, whose portfolios mirror that of a benchmark index. The latter exemplifies passive management, since few investment decisions have to be made by human fund managers. The former challenge does not use human beings at all other than the programmer writing the algorithm. As a result, both can charge far lower fees than human fund managers can charge. However, according to some surveys, these lower-cost alternatives will often outperform actively managed funds either outright or in terms of overall return, primarily due to them not having heavy fees dragging them down. The pressure from this dual competition is why investment management firms must hire talented, intelligent professionals. Though some clients look at the performance of individual investment managers, others check out the overall performance of the firm. One key sign of an investment management company's ability is not just how much money their clients make in good times, but how little they lose in the bad. Investment management firms. The top 20 investment management firms control 45% of all the global assets under management. According to the Willis Towers Watson report mentioned earlier, some $59 trillion worth. In the United States, the 5 leading firms include, in descending order, investment management process. Investment managers typically design a portfolio with the client's interests in mind. This can include meeting with the clients to discuss their investment goals and risk tolerance. Based on the client's feedback, the investment manager then buys the assets and securities to fill the client's portfolio. From then on, the manager will occasionally rebalance the portfolio as the market changes. The frequency depends on their agreement with the client. In some cases, it may be assessed once a year, once a quarter, or even every month. The more actively a portfolio is being managed, the higher the management fees. Investment managers may also provide advice to their clients in other areas, such as how to save for college or retirement. What is quantitative investment? Quantitative investment refers to investment strategies that rely on mathematical formulas to identify assets with high profit potential or low risk. Quantitative asset managers are likely to use computer modeling or statistical tools to identify potential investments that have been neglected by the wider market. What is the difference between wealth management and investment banking? Wealth management and investment banking are two common career paths in the financial sector. The main difference is their clients. Wealth managers help individual clients invest their savings, while investment bankers serve corporate clients. How do investment management firms make money? Investment managers charge a fee for their services. The exact fee structure depends on the manager and the client's needs. Most will charge a small percentage of the client's assets, a share of the annual gains, or an annual fee. Some managers may accept a flat fee for a one-time consult. Investment management is the business of handling another person's assets to help them reach their investment goals. This can entail choosing the best assets for future gains or choosing safer assets as a way to preserve wealth from market risk. Investment managers have strict ethical and legal requirements to act in the interests of their clients. What do you think of our video? Let me know in the comment section below. If you enjoy this video and want to hear from me again, Be sure to hit that subscribe button before you go. Thanks for watching.